We're going to be talking to a doctor out in Idaho. A lot of typical questions. A lot of folks have been sitting on the sidelines over the last couple of years as they start to see interest rates go up. Picked out some of these questions and decided to read it back to you guys. But here we go. Let's get into it.
Okay.
Tell me a little bit what you've been up to alternative investing wise, like any rentals.
I have been looking at syndication for about 3 years. I have what you call the traditional SAD investments, trying to learn the terms I haven't taken your entire course. I've had some difficulty just getting onto your website, actually, with not having access. So in terms of my interest in talking to you, it was answering some questions around those topics. But more importantly, just getting to know you a little bit better. I understand that you, at least the way you advertise yourself, you are creating something of a tight-knit investment group. And that's very attractive.
Part of that tight-knit group is I have calls with every single one of you guys, and then I unlock those courses. But yeah, you picked up on my Sad American Diet reference.
What is the strategic reason for coming to an investment club rather than asking a bank for a loan to do these apartment deals or any deal for that matter?
We do both. If you think of the capital stack, the bank takes up majority of it, 60 to 70% of it, but you need that down payment. That's where we all come in, right? We pick up that 20, 30% sliver.
And when you're doing a capital raise from your investment group, your goal is to hit 20 to 30% as a down payment. And then the rest of it is financed by a bank.
Correct. And then like CapEx stuff in there, which could be 10% in a value add project or a lot more in a development, right? Development's a huge chunk, but that's pretty much the gist. It's no different than you go buying a single family home, adding some renovations, etc.
In your most recent podcast, you were viewing the last few years, deals in 21 and 22 are getting hammered, meaning that the investors, I'm assuming, are not getting their investment returns and things don't look very good, which is just bad luck because the market situation was bought at a way higher price than it is today, such that those folks just invested at the wrong time.
Yeah, man. I think I'm probably one of the most transparent people out there instead of all these talking heads. Shit got crazy in 21 and 22. If you bought at that time, you bought at the peak of the market, right? And you never know when that's going to be.
What are the macroeconomic events that cause that? When you say it was at the top of the market, do you mean the valuation of apartment buildings was at its highest since 2008? My basic understanding from what I read about real estate investments is that prices are high due to a supply and demand problem. There's a shortage of supply, and this isn't changing because the interest rates for building new properties are quite high. Given this, it's curious to me that you believe the deals were just bad from 2021 to 2023. Could you explain why?
You're reading mainstream news and they don't capture any of this until 3-4 years later. And to separate residential and commercial is totally different. Residential is under 4 units, call it that generally. 2 different dynamics. In residential world, people are stuck with their mortgages, so that nobody's moving and there's still low supply, which is why the prices have stayed intact. But in commercial real estate, because of the dynamic of the loans, you don't get 30-year mortgages in commercial real estate. It's all under 5-10 years. And that's why the macroeconomic thing, 95% of it, the interest rates skyrocketed to a 40-year high, the quickest time in history. And that created a bunch of buyers, like myself, I'm a buyer too. We haven't bought anything since summer of 2022 because the interest rates are too high. And that's why your buyers left the market. Transaction volume is 10 to 20% of what it was a few years ago, and prices plummeted because it's a supply and demand dynamic.
You were saying that, in the words of Warren Buffett, when everybody's afraid, that's when the investors should jump in. If interest rates are still high, then why would you want to buy a property now? Would the idea be to buy at a high interest rate and then refinance, be it in a year or two, when you expect the rates to come back down?
Yeah, if you got the cojones, you buy when the interest rates are high and you ride that rate down with a floating rate. But when interest rates are high, that's when your prices beat down the most. When the interest rates come back down, that's your trade winds behind you. So you want to be in the water before this great decrease of interest rates, right? When the interest rate is high, from a competition standpoint, people aren't out there buying. So prices are low. That's the time when you should be buying, right? Not the time in 2021 when all signs looked like it was green. It was euphoria in the market, right? That's the bad time, right? That's now, this is all in hindsight. Nobody knows the future, but that was a situation 18 months, a year ago. the ugly truth that's out there that nobody's talking about. You bought a property in 2022, $60 million property, and now it's worth 40. Your senior debt is 45. So you're underwater by $5 million. Common equity capital is long gone, disappeared, right? But everybody thought that interest rates would start to have some relief a year ago. Look at the Chatham financial curves. That was what the tea leaves were saying. Lesson learned.
I have a question about that, another way to look at that, and maybe I'm wrong, and this might be a fundamental misunderstanding. Every single deal that I have seen has had an exit strategy in the 3 to 5 year range. And there's a ton of little language on these contracts, as I would expect there to be for such an investment. But I always found that as curious. The number of people, yourself included, I'm sure, who have a buy and hold mindset. I'm going to buy this house, and some years I'm going to cash flow, and some years I'm not going to cash flow. But I'm going to hold it for 10 years. And by the end of it, the appreciation is going to be such that it's going to be part of my retirement. I don't see that in the syndication world.
That previous strategy that you mentioned, like I call it the buy, hope, and pray strategy. That's what I did when I first started, right? Like I would buy these little turnkey rentals and then just put the debt on it, and then you barely cash flow. The majority of the money you make is through the value add process, not the buy, hope, and pray strategy. The buy, hope, and pray strategy is just crossing your fingers. You make way more money by doing the value add. Then think about it like you're sitting in a canoe out in the ocean. Buy, hope, and pray is you're sitting out there without an oar. You're just letting the currents take you. And we all know now, obviously, that the markets go good, they go bad, right? Where the value add strategy comes in is now you're able to force appreciate the asset and get in, get out. And especially with commercial assets, they degrade over time. You don't want to be holding on to like a 1970s, 1980s properties forever. You want to go in, bump the value, get the hell out of there. I thought the same thing for 10 years, right?
But if you're in a good neighborhood, you know that you guys like to rate neighborhoods. And if you're lucky enough to have found a place that's not in a S-hole, then I would assume that apartment building is still something that would have some value to it.
The problem is that the value add is like dry powder. If the market were to correct, you can force your way through the current, to use that analogy. Some of these deals, like we've exited in 2.5 years, right? And people are like, why don't you stay in it? For many different reasons, right? Every deal is unique, right? But on one in particular, I'm thinking like that location wasn't the greatest. But maybe if you're saying, well, what if it is like a neutral to appreciating or gentrifying area? I'm like, we can find a gentrifying the same par level with a value add asset that we can undertake. And that we'd rather be in that position. People ask it all the time. But also too, maybe another dynamic in commercial real estate, the loans don't go longer than 12 years too. Typically, you don't want to go that long because you're going to get a little bit more expensive terms. Normally, okay, so this is everybody pre-2021, right? Because 2022 is when things got super hot. So pre-2021, I would say most people in our ecosystem use fixed rate Fannie Mae debt where it was 5 to 12-year terms. After that point, the prices got so hot, you were not able to buy a property unless you use bridge debt like everybody else did out there.
What is a bridge debt?
So it's a loan where you go in and you have to renew it in 2-3 years or less. That creates a situation where you can get caught, right? Like in this kind of perfect storm that happened. But typically, if you think about it, the bridge note is exactly the tool for this job because we're going in, ripping and roaring, renovating unit. And in a sidewards to even a 10, 20% downward market will be at par, right? But that's where when the market goes down 30%, you're SOL. I'll kick you out. The syndication e-course I got is 8 hours and you can go you can go Control F and go into the loan section and I'll rehash this stuff. It's kind of a little bit more advanced, but I would say like for LPs, like just know what kind of deal you're going into, what kind of debt terms. Like I said, at this point, that's exactly what you want to do, right? Go into bridge notes and ride that rate down, especially if it's an aggressive value add strategy. But you can get caught in one of these monumental corrections, which commercial real estate has gone down more right now, more than it did in 2008.
So you are, as you said before, salivating over this market.
Gingerly, like I don't know if you check my story, but like real estate is how I got my net worth to where it's at. And I'm super passionate about like the tax savings it gets you. especially for high income earners and the infinite banking when you combo that with it. But maybe I'm maturing as an investor. What I did 80, 90% of my net worth into this stuff, right? Maybe I'm somewhat getting old and I'm like, maybe 50, 70% is the right value for me personally. And that's where I'm branching out. And most people, what I'm realizing now is as I was benchmark myself against other investors in my experience level is you start to branch out into venture capital, private equity, buying brick and mortar businesses. So I'm exploring that. But I always say I don't claim to know it all, but and constantly trying to like tinker things. But I think if your net worth is under $2, $3 million, like real estate's the way to do it, especially when you get the tax benefit. So
I'd still have quite a bit more to learn on the infinity banking thing.
don't worry about the IBC. That's more of like the high hanging fruit there. We have the e-course for you. It's maybe 2, 3 hours, or just watch the webinar, the hour-long webinar on it. But for you, it's probably like the taxes first and then the deals. But unfortunately, to get the passive losses, you got to invest in deals. So you got to put your ass out there first. So that's why I say like it's the deals first or the syndication e-course first for a guy like you. You're a cookie cutter like guy I normally talk to. Most of the guys I used to talk to 5 years ago, they were cats like me that bought a lot of little rental properties and transitioning over. But since then, the last several years, or since 2020, a lot of guys like yourself, right, never owned rental properties. And you don't need to know about that stuff. Rental properties are a pain in the butt, but you guys are coming at this a little cold, right? So again, that's where I suggest going to the syndication e-course. Academically, you'll know more than most of these accredited investors because most of these accredited investors don't really know much, especially the ones on the internet forums out there. But then that's where we have my paid mastermind group, and we allow you guys to come to one event to test drive us out in terms of community. But that's like the next step for you, right? You got to find 4 or 5 good compadres to ruminate on these types of deals. And it's a relationship business at the end of the day. What I see most investors do, but I think 1 out of 3 people step forward and try this stuff out. There's obviously risk involved in it, right? Especially working with the wrong people. Like when I first started to do this back in 2015, 16, like my first 15 deals, 3 of them were with like douchebags, right? Because that's the part about this world. Like everybody has a good internet site and a fake it till you make it. I've gotten to a point where 60, 70 plus deals, $2 billion assets. I think that would be the first place to look, right? Is like, how much AUM do they have? Is this just a doctor group that is raising $2 million for operator and has really no skin in the game and illegally raising capital? Or is this the group that has taken the lumps as we have over the years, know what to look for and are operators, right? But I think that's a little bit more like down the road, right? I think you have to get into a few deals and then you have some street cred to talk with other LP. I guess I'll close with this stuff worked. It worked for me. It was in different times though, right? Like I started in 2009 and rode this amazing wave up to 2022. Some would say lucky bastard, right? But if you're taking more of a conservative approach on this stuff, like just stick to fixed debt deals that have loan terms of more than 5 years on it. And when you read the e-course on it, I think you'll see why. You're not going to more than double your money every 5 years, but I don't think that's what you're really looking for anyway. But the gotcha is like investing with kind of fake it till you make it sponsors and operators and syndicators out there. Good luck. But hey, man, we've all done it. You know, we all like dated around the wrong people and lost money. Like, I think that's, if you've got the income and net worth, that's a part of investing, right? Like my first deal I did in 2012 as an LP, I just lost it all 40 grand of it. And then a couple of times again. And it's just, if you're a guy who gets all pissed off and is going to waste more time grumbling on it, this world isn't for you. The attitude needs to be like, I just need to network more and investigate. And eventually, once you're in it for maybe 3 or 4 years and you've properly networked, I think you'll have a good group of people around you. But again, the trouble is finding that honeypot of people, right? There's really no other group like mine out there that's more relationship first. And these internet forums are just a bunch of these other operators on there kind of hiding and putting in fake reviews and comments all the time.
Yeah, when I listened to you, it's the first time that I was made aware that there was some shady characters in the world. So I appreciate that.
Yeah. It's numbers at the end of the day, assets under management. Unfortunately, you guys don't have access to Yardi or CoStar. So you can't really see what their previous properties are and you can't see what they're performing at. So that's what makes it tough for you guys.
It's never, you have to get in, I think. You can't ever really understand something until you've done it. There's only so much research you can do.
As far as my side goes, that's the checkbox I wanted to hear. I think that's the right attitude. It's going to be uncomfortable and just got to learn by making a few mistakes, is the way I look at things. I'll send you some of these older quarterly reports I do, and what I would go look back and buried in the middle in there, but it'll go over what the hell happened this last couple of years. But count your lucky stars, you didn't jump in 2021.
Yeah, no, I do think it was lucky. It certainly wasn't intentional. It's not as if I looked at the market and decided this was a bad idea. Mostly, I just sat there waiting because I was taking my time learning. But it seems like that was the right way to do it.
Yeah, and that's what kind of makes me like a little sad is that sometimes it's good to be lucky. And I tell my protege, I'm like, dude, I don't understand this investing stuff. It goes against everything. Like when you feel uncomfortable, that's when you should move forward. When you feel like it's all gung ho, like we just did this venture capital deal. Like when it all looks good, that's when you should pump the brakes, right? So I don't know. That's investing, right? I just try and emulate what higher net worth folks do. And that's the attitude and the vibe that I take away from them. After a while, it gets fun, right? You play with house money and you meet some cool people. Yeah, if you need anything, just shoot us an email